So we're not in normal markets. This feels weird, and it's as if the markets are taking after somebody in the White House and not caring anymore and just doing what they want.
Yeah, it's been a strange couple of years. Like over the last 3 years almost, we've had high double-digit returns in equity markets. Now, if you take a step back and have a look at what's happened over that period, we've had the Russia-Ukraine war, conflict in the Middle East, trade wars, geopolitical concerns, persistently high inflation, interest rate regimes changing, and the market just doesn't seem to care. The returns have been really quite outsized compared to what you would expect when you had a look sort of what was happening from a geopolitical and economic perspective.
And what is driving the markets not to care? Is it the unlimited growth that seems to be coming out of AI in the MAG7? Or I don't know, because I think in the first time in a long time, you see all this stuff where, and I think a few weeks ago we shared it on a show where some of the top terms searched in the US was like how to repo or how to sell my car cheap, bankruptcy lawyer, sell stuff, like all this stuff where looking in, a casual observer would think, geez, everything's going to crap.
Yeah.
And it's as if the main street is so much disconnected from Wall Street.
Well, it's really interesting because what you have is a two-speed economy, effectively. And the data at a headline level looks good. So as you say, sort of the GDP is still reasonable, economies have held up. You have a look at somewhere like the US, which is going to, important when you're thinking about the MAG7, and the consumer is, spending, they're looking fairly solid. However, when you then start to get down into the details of that, what you see is that the vast majority of consumer spending in the US, for example, is actually supported by the most wealthiest consumers. Now, the most wealthiest in the US, there's a wealth effect associated with the stock market returns because in the US, they have one of the highest participation rate in the share markets. So that wealth effect of asset prices has made the consumer confident and they're continuing to spend. When you go down, though, and have a look at sort of the middle and lower class where they don't have as much disposable income, you're starting to see an increase in delinquency rates on credit cards, etc. So there is this two-speed economy and there are some cracks that are starting to show. But overall, as a whole, the headline data still looks okay. Companies, their earnings are actually, they keep beating. We've just gone through earnings season and it has been one of the biggest sort of beat markets that we've seen in a long time.
Yeah, it's so fascinating because when you look at markets and you kind of, hindsight's wonderful and you look at before the GFC and the amount of debt that was around, like the debt isn't there like it was pre-GFC. So it almost feels like, well, are we heading towards a cliff? But then you look at the MAG7 and I don't know, I just think the whole thing's so weird at the moment. And a lot of people might be thinking, well, why do we talk so much about the US? And, well, the US is important given the size of the economy. And it's just a weird, funky time. And that's not even a question. I'm just throwing fodder out for you to pick at.
Sure. I'll pick away.
Yeah.
Yeah, and you're right. The US is an important area for us to discuss for a lot of different reasons. The size of the economy, the size of the share market and the MAG7, and we can kind of circle back to that, just how globally important it's actually becoming. But then also the fact that the US dollar denominated finance system that we have. So most transactions that occur around the world happen in US dollars. So it's a really important economy to understand and be across. And a lot of the geopolitical tensions at the moment coming from the tariffs and so forth and how that will then ultimately lead to what's being referred to as deglobalization, so where people start bringing things back in control of their countries. For a really long time, countries have operated during that process of globalization as if sovereign borders didn't matter. So the free flow of capital, of goods, et cetera, between. COVID kind of shifted that a little bit. And it wasn't just COVID though, because there's been, a lot of people would say globalization has been great for everyone, but it actually hasn't. There's an entire middle class where actually, and particularly, and this is why populism rose quite substantially from a political perspective, there's an entire generation of middle class who are worse off than their parents.
Oh, yeah.
globalization did not benefit them at all. And we're starting to see a reversal of that with his populism. And that's why you're seeing a lot of the policies that Trump's trying to implement.
And it's so savage. Even in Australia, the ABS released, the last tranche of data around the median incomes. It was almost like household income, maybe around 120 as, the bottom watermarker, and then daylight, and then 350.
Yeah.
And it's like, okay, where's the middle class?
Hence the two-speed economy.
Yeah.
So it depends on where you're at and how you're feeling at the moment.
The two-speed economy, it's interesting you say that in terms looking into the US. People might be slightly triggered from those words. I know it provoked thought with me when we had the mining boom here in the early 2000s.
Yep.
And to a point, actually, I got so we help people find a financial advisor through our website. We had someone inquire the other day, and they were an admin worker in mining.
Yep.
Both of them, husband and wife, they were both earning $200K each.
Wow.
And so it's still there, but not as savage.
Yep.
I mean, that's a whole debate about, well, if you're sick of FIFOing or whatever,
Yeah.
You're not going to find that type of money in your local area. But I don't know, the whole thing's fascinating at the moment. And we are going to talk about this and a whole heap of other random money stuff. But who have we got and what are we doing?
So I'm Jody Fitzgerald. I'm from Australian Retirement Trust, and you're listening to Money, Money, Money.
So we talked about, at the top of the episode where it's not a normal time, the markets don't seem to care.
Yeah.
They're just running along. So what are some key trends that you and your team in portfolio land really looking at? Are we talking bubbles, tulips, all that stuff?
We do get asked a lot about, is there a bubble in tech? And I think it's interesting. What I always do, personally, what I've always done in my career as an investor is sort of take a step back and go, okay, hang on, let's zoom out here and what are the key pieces of information that we should look at to unpack that. So yes, the Magnificent Seven are huge. Actually, and to put it into perspective, the top 5 stocks in the US currently account for 16% of the global equity market. What that compares to is that if you took the top 50 stocks out of Europe, all of the UK market, all of the Australian market, all of the Japan market, and all of Canada, it's equivalent to the top 5 US stocks. So they're huge, right? If you take the top 10, of which 8 are tech companies, it's about 25%. That is exactly the same as the equivalent to the GDP of China or 5 times the GDP of Germany. So this is why you've got this sort of hugely influential and that you've had these multi-year high double-digit returns that sometimes feel like, but it's not reflecting the
Main Street
tensions.
Well,
The Main Street data still looks okay, right? And it's not, but as I said, it is 2 speed, so we need to sort of think through that. But it's certainly not reflecting some of the tensions in the world and that would normally impact share markets. But if you then sort of look at them and go, okay, the valuations look rich, and that's the whole question. Is it a bubble? Are they overpriced, or can they be justified? The interesting thing about where we're at this phase of the cycle is that when you actually then have a look at the earnings of these companies, it's quite different to compare it to what happened in the dot-com. In the dot-com, you had really high, rich valuations, but no earnings.
No money, yeah.
There was no money. There was no substance. We were basically buying promises, effectively. The current situation is these are highly cash generative, very profitable businesses with extremely high return on equity. So arguably, you could put a case forward saying, well, maybe the higher valuations are justified. Maybe, right? The challenge in all of this, though, is that if you hear some of the numbers that is being spent on AI, like it's something like $1.5 trillion, or it's a huge number. And in a lot of instances, some of this AI hasn't added value yet. So the question for going forward is then that, yes, there's a huge amount of capital expenditure, or CapEx as we call it, that's actually occurring on AI. The question will be whether that CapEx eventually becomes productive. And that we don't know yet. The reality, though, at the moment, the money that is being pushed into the economy through this capital expenditure is adding to growth. So that's why you've got this interesting situation of the economies haven't slowed down as much, because the reality is CapEx spending at the quantum that it's being spent at is actually good for the economy. Now, what could happen is that expenditure is eventually written off. It's just depreciated because it didn't add value. That's a different question. Then you'll see some corrections come through. So at the moment, it's hard to see what the turning point is. There's some interesting changes, though, in the dynamics of the market that are starting to take place. One is that what you would have seen is a lot of announcements of, be it the modelers of the AI or the people with the infrastructure, et cetera. There's all these cross deals going on.
Yeah, and that's what I wanted to – the scary thing is when you look at the overlay of, OpenAI, NVIDIA, all these companies taking equity stakes in other companies and this web, it's like...
And when you start to get that web of complexity, that's like the first, you think about the cycle of what happens in a typical cycle, that complexity starts increasing and that's starting to occur. Yeah. It's a little bit hard
Junk bonds,
et
cetera.
Like how do you distinguish between the consumer, the supplier and the distributor? The web's making that a little bit harder. Some of these deals, so what's starting to also happen is they're starting to finance some of these deals through debt. Whereas before, they're just so cash generative. We've just got heaps of cash. We'll just put it over there and we'll just keep going.
Yeah, so the debt's starting to walk in the door.
The debt started to walk in the door. Is it a problem for them now? No, because they've got enough cash to back that debt. But it's an interesting step into the next phase of what is a normal cycle. The other thing that you usually see when you start to hit that sort of bubble territory is you get a lot of entrants into the market trying to take profit share. We haven't really seen that yet. We haven't seen that sort of massive, new businesses and startups and so forth trying to do that profit share. So it's hard to really work out exactly where we are in that cycle, other than to sort of acknowledge that some of these valuations could be justified. It is, as an investor, it sits a little uncomfortably to say they look rich, but they're earning money.
So have you guys seen from your portfolio managers who might manage US equities, have you had any commentary where they're taking some money off the table from some of the MAG7s?
Yeah, quite a few of them are underweight.
Right.
And we have a lot of passive investment in our portfolio as well, which means we get the index weight from that perspective. So on a whole, we would be, slightly underweight these sort of areas. The degree to which you would want to then move substantially away, I just think that's a really hard call to make because the reality is it's really hard to pick a bubble and when it will burst, right? So the degree that there's two calls that you're making when you go heavily underweight an asset. You're making a call that's in a bubble or it's going to have a valuation adjustment. You're also making a call on the timing of that. And what I'm saying in this is the timing's not clear at the moment where we're at in the journey. I think what's really probably more interesting from an investment perspective is trying to understand where do the winners ultimately lie. And it's not necessarily in the companies making the AI. It'll be in other industries that adopt AI that then get better efficiencies, get better sort of balance sheet, control, et cetera. That will probably then be the next phase of that you'll get a better, hopefully a better dispersion of return profiles. Because at the moment, if you break down the return of the S&P 500 and you strip out the MAG7,
it's flat for the last.
Done nothing really. Yeah.
Far out. So looking ahead to next year, what's your general vibe, or are there any other themes that you think will be particularly important?
I think one of the key themes is that we're going to continue to see volatility. So even though I've mentioned that we've had high double-digit returns, that's not to say it's been a single ride. Like there's volatility all over the place. You'll get an announcement over, and it's usually related to policy, be it tariffs or whatever.
If Barron Trump wants to make $100 million, he might tap Dad on the shoulder or steal his phone and make a tweet.
Basically,
all that stuff.
100% right. So there's huge amounts of volatility. So for us, it's being in a position to take advantage of that volatility when it plays out, rather than trying to, for a fund like us that we're quite large, to sort of sit there and try to predict. That's not what we do. That's not the way we invest.
But also you have to deliver what's on the box of the portfolios.
100% we do. 100% we do.
This is a percentage allocation to this sector or whatnot.
Yeah. But what we want to do is that if you actually spend time trying to predict that, okay, the MAG, let's just say we predicted a certain asset class is going to fall. If you position against that, so in other words, you underweight it, you could actually miss the the upside could continue for a few years.
Yeah.
So you actually destroy member wealth doing that. So you miss some of the wealth generation that's available. What we do, though, is that as these volatility moments present themselves, going back to the liquidity conversation, is stand ready to offer liquidity to the market when the market's trying to sort of move in the opposite direction. So back
to your liquidity and defensive portfolio, if there was an event or something in the equity team are like, we think this is a buying opportunity, they may tap your team on the shoulder and say, we need an extra $200 billion. Can you get it to us?
The way that we will usually implement that is through our dynamic asset allocation program. And what they will do is they will usually implement derivatives to those calls. Those derivatives then need to have initial margin posted. So we don't have to post, like to your point, it wouldn't be the 200 million. It would be the initial margin that we have to post to cover the derivative. It would be the collateral management of that delivery. So that's what my team would do to ensure that we can actually facilitate the DAA team taking that position and taking advantage of the volatility.
Yeah, interesting. Hey, it's Glenn here. Thank you so much for watching today's video. You made it to the end. Can I ask a favor? Can you hit that like button and maybe hit subscribe if you want to get notified when we release further videos just like this one, whether you watch the Money, Money, Money podcast or Retire Right. And remember, if you want to learn more about investing, I've got an investing book, The Quick Start Guide to Investing, and there's a link in the description to get your hands on a copy. Thank you so much. Bye.